I want you to understand something before we go any further. Going broke in trading is not proof that you are stupid, unlucky, or incapable. Going broke is often proof that you are learning the wrong lesson. Most traders believe that blowing an account means they need a better strategy, more indicators, or inside information. But the real reason traders go broke again and again has nothing to do with the market. It has everything to do with how they think about the market. The market does not punish you. It does not reward you. It does not care who you are, how badly you need money, or how confident you feel. The market simply offers opportunities, and it is your relationship with uncertainty that determines whether you survive long enough to benefit from them. Many traders have to lose everything multiple times before they finally see the truth. Consistency is not created by intelligence, effort, or willpower. It is created by alignment between your beliefs and the realities of how markets actually work. This is the secret that turns repeated failure into long-term survival and consistency. Most traders say they understand that the market is uncertain, but their behavior proves they don't. Understanding uncertainty intellectually and accepting it emotionally are two completely different things. The market can be random in the distribution of outcomes, yet traders continue to act as if the next trade should somehow make sense, should justify their analysis, or should reward their effort. This hidden expectation is the root of almost every trading mistake. The market does not know you are in a trade. It does not know how much you risked, how confident you felt, or how badly you want the trade to work. Every tick that prints is independent of your last trade and indifferent to your opinion. Price moves because of collective participation, not because of your logic. When you truly grasp this, something important happens. You stop trying to control the market and start focusing on the only thing you can control, your behavior. Randomness in the market does not mean chaos. It means that while outcomes are uncertain on a trade, by trade basis, they are consistent over a large enough sample size if you have an edge. This distinction is where most traders fail. They evaluate themselves based on individual outcomes instead of the quality of their decisions over time. One loss feels like proof they are wrong. One win feels like proof they are right. In reality, both are statistically meaningless by themselves. When you react emotionally to a single outcome, you are responding to randomness as if it were personal. That reaction is what creates inconsistency. Not the market, not volatility, not news. Your behavior. Every emotional reaction in trading comes from an expectation. If you expect certainty, you will feel fear when it doesn't appear. If you expect a trade to work, you will feel frustration when it doesn't. If you expect the market to validate you, you will feel anger when it ignores you. The market violates expectations constantly because it was never designed to meet them in the first place. Consistent traders have removed expectations from individual trades. They don't need the next trade to win. They don't need to be right. They don't need immediate confirmation. They only need to execute their edge exactly as planned. That mindset eliminates emotional pressure because there is nothing at stake psychologically in any single outcome. Most traders say they have rules, but rules mean nothing if you don't trust them. And trust does not come from hope. It comes from understanding probabilities deeply enough that you no longer need certainty. When you truly believe that anything can happen on the next trade, you stop being surprised by losses. And when you stop being surprised, you stop reacting. Reaction is what kills traders, chasing after losses, hesitating after wins, leveraging to make money back. These behaviors are not random. They are predictable responses to emotional discomfort. And emotional discomfort only exists because the trader believes the outcome should have been different. The market did nothing wrong. It simply expressed one possible outcome. Your job as a trader is not to predict which outcome will occur. Your job is to participate in a way that allows your edge to play out over time. That requires consistency of behavior, not consistency of results. Results will always fluctuate. Behavior must not. Think about this carefully. If you knew with absolute certainty that your edge would produce profits over the next 1,000 trades, would the next loss bother you? Of course not. You would execute without hesitation. You would size properly. You would follow your plan effortlessly. The only reason you don't behave that way now is because you don't fully trust the probabilistic nature of your system. Trust is not built by winning. Trust is built by execution. Every time you follow your rules regardless of outcome, you reinforce the belief that your behavior matters more than the result. Over time, that belief becomes stronger than fear. When fear disappears, discipline becomes natural. Most traders try to eliminate fear by seeking more information. More indicators, more confirmation, more analysis. But fear does not come from lack of knowledge. It comes from lack of acceptance. You are afraid because you want certainty where none exists. Once you accept that uncertainty is permanent, fear loses its foundation. You stop needing the market to behave in a certain way. You stop interpreting losses as threats. You stop taking wins personally. The market becomes neutral, and neutrality is where objectivity lies. Objectivity allows you to see opportunities without emotional distortion. It allows you to enter when your edge appears and exit when it doesn't, without regret, without hope, without hesitation. This is not emotional numbness. This is emotional clarity. The irony is that traders who accept randomness make the most consistent money. Not because they predict better, but because they stop interfering with their own process. They don't sabotage winning streaks with overconfidence. They don't sabotage losing streaks with fear. They remain stable while outcomes fluctuate. Stability is a psychological state, not a market condition. The market will always be unpredictable in the short term. Volatility will change. Conditions will shift. None of that needs to affect your behavior unless you allow it to. The moment you decide that your job is execution, not prediction, trading becomes simpler. Still challenging, but clean. Randomness stops being threatening when you expect it. Losses stop being painful when you understand them. And discipline stops being difficult when there is nothing left to fight inside your mind. The market does not need to change for you to succeed. You do. Once your behavior is no longer dependent on outcomes, you have crossed a psychological threshold that most traders never reach. From that point forward, consistency is no longer something you chase. It is something that emerges naturally from alignment with how the market actually works. The market can remain random forever. Your behavior doesn't have to. Most traders believe discipline is something you force. They think discipline means fighting urges, suppressing emotions, and overriding fear through willpower. This belief alone creates failure, because anything that requires constant self-control will eventually break under pressure. Markets apply pressure every day. If your trading depends on effort, strain, or emotional resistance, it will collapse when it matters most. True discipline is not an act of control. It is a state of alignment. It is what happens when there is no internal argument about what to do next. When your beliefs match the realities of the market, disciplined behavior requires no effort at all. You simply execute. Inner conflict is the real enemy of consistency. It shows up as hesitation before entry, regret after exit, fear of pulling the trigger, moving stops, taking profits early, or revenge trading. These are not character flaws. They are signals that part of you believes one thing while another part believes something else. One part of you understands that losses are normal. Another part feels personally threatened by them. One part of you knows that uncertainty is unavoidable. Another part demands certainty to feel safe. As long as these beliefs coexist, discipline will always feel difficult. Most traders never resolve this conflict. Instead, they try to overpower it. They add rules. They add structure. They add external constraints. But rules do not eliminate conflict if the beliefs underneath them remain unchanged. When pressure increases, the strongest belief always wins, and that belief is usually fear. The market constantly exposes inner conflict because it forces you to act without certainty. Every trade requires a leap into the unknown. If you are not completely at peace with that reality, your mind will search for safety. Safety-seeking behavior is what destroys discipline. Discipline disappears the moment you need a trade to work. Needing a trade to work means you are emotionally invested in the outcome. Emotional investment creates tension. Tension creates impulsive behavior, and impulsive behavior destroys consistency. Professional traders are not more disciplined because they try harder. They are more disciplined because they expect nothing from any single trade. Their expectations are neutral. Their focus is on execution, not outcome. There is no emotional struggle because there is nothing at stake psychologically. This neutrality is not indifference. It is clarity. Clarity comes from accepting the market exactly as it is, not as you want it to be. The market offers uncertainty. It offers incomplete information. It offers random outcomes within probabilistic structures. When you stop resisting these facts, inner conflict dissolves. The mind resists uncertainty because it wants control. Control feels safe. But in trading, control is an illusion. The only thing you can control is how you behave in response to what the market does. The moment you try to control outcomes, you create anxiety because outcomes are uncontrollable. Anxiety is simply awareness of risk combined with resistance to uncertainty. When you stop resisting, anxiety fades. Most traders think discipline means sticking to rules even when it feels uncomfortable. But why should it feel uncomfortable in the first place? If following your rules feels painful, Your beliefs are not aligned with your rules. Something inside you disagrees. That disagreement might be subtle. It might sound like, this setup doesn't feel right, or I'll just wait for more confirmation, or I don't want to give back profits. These thoughts are not logical analysis. They are emotional negotiations with uncertainty. Negotiation is evidence of conflict. When you truly accept that losses are costs, not failures, you no longer argue with your stop loss. When you accept that missing trades is irrelevant, you no longer chase. When you accept that winning streaks mean nothing, you no longer overtrade. Acceptance ends negotiation. Discipline becomes effortless when your primary goal is flawless execution, not financial outcome. This shift is subtle but profound. Execution is always within your control. Outcomes never are. As long as your goal is money, you will feel pressure. As long as you feel pressure, you will experience conflict. And as long as there is conflict, discipline will require force. The paradox of trading is that money comes as a byproduct of doing everything else right. It cannot be the objective during execution. The moment money becomes the focus, fear enters the process. Fear does not mean you are weak. Fear means something matters too much. Consistent traders care deeply about following their process and are emotionally detached from individual results. This combination eliminates inner conflict. There is no debate about whether to follow the plan. The plan is followed because it aligns with their beliefs about how markets work. Beliefs drive behavior, not rules, not motivation, not discipline techniques. You can write the best trading plan in the world, but if you secretly believe you must avoid losses, you will sabotage it. If you believe you must always be right, you will override it. If you believe winning proves your worth, you will distort it. Inner conflict will always reveal itself through behavior. The only way to eliminate conflict is to examine and correct the beliefs that create it. You must redefine what a loss means. You must redefine what success means. You must redefine your role in the market. Your role is not to predict. Your role is not to avoid pain. Your role is not to control the future. Your role is to execute an edge with consistency over time. When this belief becomes dominant, discipline stops being a struggle. It becomes your natural state. There is a moment in every trader's development where forcing behavior no longer works. That moment often comes after repeated failure, after broken rules, after emotional exhaustion. This is not the end, it is the beginning. Because at that point, you finally stop trying to control yourself and start understanding yourself. And once understanding replaces resistance, discipline emerges without effort. No struggle, no force, no self-control, just clarity, alignment, and consistent execution in an uncertain environment. That is what real discipline looks like. Most traders don't realize that the real risk in trading has nothing to do with money. The greatest risk is psychological. It is the moment you allow your self-worth to become entangled with the outcome of a trade. From that moment forward, trading stops being a decision-making process and becomes a referendum on who you are. That is where consistency dies. The market does not reward confidence, intelligence, or effort. It does not punish weakness or fear. It simply reflects order flow. But when you attach your identity to results, every fluctuation in price feels personal. A win feels like validation. A loss feels like rejection. And once trading becomes personal, objectivity disappears. Identity attachment is subtle. It doesn't announce itself loudly. It shows up as pressure to be right, as frustration when a trade doesn't work, as hesitation after a loss, as overconfidence after a win. These reactions are not about money. They are about meaning. When a loss means failure, you will avoid taking the next trade. When a win means success, you will try to repeat it. Both behaviors distort execution. Both come from the same source, the belief that outcomes define you. Professional traders do not think this way. They do not use the market to measure their value. Their sense of identity exists outside trading. Because of that, they are free to engage with the market objectively. Losses do not threaten them. Wins do not inflate them. They remain emotionally neutral because nothing about their self-image is at stake. Most traders never reach this state because they come to the market seeking something beyond money. They seek proof. Proof that they are smart enough, disciplined enough, different from the crowd. The market cannot provide this. And the attempt to extract identity from outcomes creates endless emotional pain. The irony is that the more you need the market to validate you, the worse your results become. Needing validation creates pressure. Pressure narrows perception. Narrow perception leads to poor decisions. Poor decisions reinforce negative outcomes, which then further damage identity. This loop can destroy both confidence and capital. Detachment breaks this loop. Detachment does not mean you stop caring. It means you stop assigning meaning to things that are inherently meaningless in isolation. A single trade has no significance. A string of losses has no moral implication. A winning streak says nothing about the future. These events only matter statistically over time. When you detach your identity from results, you begin to see losses for what they really are: operational costs. They are no different from rent, data fees, or commissions. Necessary expenses in the pursuit of long-term profitability. There is no shame in them. There is no pride in avoiding them. As long as losses feel painful beyond the financial impact, identity is involved. The market is a powerful psychological mirror. It reflects your beliefs back to you through your behavior. If you feel anger, fear, or euphoria, it is not because of price. It is because price touched something inside you that is unresolved. Trading outcomes reveal attachment, not skill. Most traders respond to this discomfort by trying to manage emotions. They look for techniques to calm down, to stay disciplined, to control reactions. But emotional control is not the solution. Emotional clarity is. Clarity comes when you redefine success. Success in trading is not winning trades. It is executing your plan flawlessly. It is behaving consistently regardless of outcome. It is measuring yourself by process instead of profit. When success is defined this way, identity shifts away from results and toward behavior. Behavior is always within your control. Outcomes never are. This shift removes emotional volatility. You no longer feel high after wins or low after losses. You feel neutral, focused, present. This neutrality is not dull. It is powerful. It allows you to see the market clearly without distortion. When identity is detached, you stop protecting your ego. You stop avoiding trades to prevent being wrong. You stop holding losers to avoid admitting failure. You stop taking profits early to lock in validation. These behaviors only exist when self-worth is at risk. Ego protection is expensive. It costs traders more money than bad analysis ever will. Detachment also restores patience. When nothing about you is on the line, you can wait. You can let trades develop. You can accept drawdowns without panic. You can endure uncertainty without needing immediate reassurance. This is why many traders only learn this lesson after going broke multiple times. Loss strips identity away by force. Eventually, exhaustion replaces ego. At that point, the trader either quits or finally lets go. Letting go is not weakness. It is maturity. Once you release the need to be right, the market stops being an adversary. It becomes a probability machine. A neutral environment where your only task is to execute your edge repeatedly and consistently. This is the moment trading changes from emotional struggle to professional practice. You no longer ask, "What does this trade say about me?" You ask, "Did I follow my rules?" That single question is enough. Consistency is not achieved by confidence. It is achieved by humility. The humility to accept that you don't control outcomes and never will. The humility to accept that losses are unavoidable. The humility to accept that your worth exists independent of your results. When identity is separate from trading, you are free. Free to lose without pain. Free to win without attachment. Free to think clearly in an uncertain environment. And that freedom is what allows an edge to express itself over time. Detach your identity from results and the market loses its emotional power over you. What remains is clarity, consistency, and the ability to perform at your best, trade after trade, regardless of outcome. Trading becomes simple the moment you stop asking the market to define you. When uncertainty is accepted, inner conflict dissolves, and identity is no longer tied to results. Discipline is no longer something you force, it is something that happens naturally. Losses stop being emotional events and become part of the process. Wins stop inflating ego and become just another outcome. In that state, you trade with clarity instead of hope, with consistency instead of struggle. The market remains unpredictable, but you don't need it to change. When your behavior, beliefs, and identity are aligned with reality, consistency is no longer a goal, it is the natural result of how you think.